Welcome. Today we're diving into a topic that many families consider but often find quite complex from a tax perspective, transferring shares to relatives here in the UK.
Hmm,
And we should mention this discussion has been kindly arranged by Pro Tax Accountant, a very well-respected accounting firm.
that's right. And it's a situation that crops up for, well, all sorts of reasons, doesn't it?
Mm.
You might be looking at succession planning for a family business, maybe wanting to share profits via dividends, or perhaps it's about estate planning, trying to reduce the value of your estate for inheritance tax purposes later on.
Exactly. It seems straightforward, wanting to give something valuable to your family. But the moment HMRC gets involved, things get, well, nuanced. Transferring shares isn't seen as just a simple gift.
No, definitely not.
It can trigger capital gains tax, that's often the big one, but inheritance tax can also come into play, and sometimes even income tax, which we need to be careful about.
Absolutely. So thanks to Pro Tax Accountant arranging this, we're going to try and break down these different taxes, give you a clearer picture if you're considering moving shares within the family.
Good plan. Where should we start? Capital gains tax, perhaps? CGT?
Yeah, let's start there. It's often the immediate hurdle. The key thing to grasp is that HMRC treats giving shares away, gifting them as a disposal for tax purposes.
Even if no cash changes hands.
Even then. Because if those shares have increased in value since you first got them, HMRC sees that increase, that gain, as potentially taxable. It's as if you'd sold them at their current market value.
Okay, so it's the gain they're interested in taxing. What are the rates for that? For, say, the 2025-26 tax year?
Right. Well, the CGT rate depends on your overall income. If you're a basic rate income taxpayer, it's 18% on the gain. If you're a higher or additional rate taxpayer, it jumps to 24% for gains arising after October 30th, 2024.
And isn't there an allowance, something you don't pay tax on?
Yes, exactly. Everyone gets an annual exempt amount for capital gains tax.
Mm.
As of April 2025, that's £3,000. So you only pay CGP on gains above that £3,000 threshold in a tax year.
Okay, let's make that real. Imagine I bought some shares years ago for £10,000. Now they're worth £50,000, a £40,000 increase. If I gift these to my daughter and I'm a higher rate tax giver, how does that work out?
Okay, so you get a £40,000 gain. First, you deduct your £3,000 annual exemption. That leaves £37,000 of the gain that's taxable.
Right.
Since you're a higher rate taxpayer, you'd apply the 24% rate to that £37,000. So 24% of £37,000 is £8,880. That's the immediate CGT bill just for gifting the shares.
Wow, nearly $9,000. That's significant, isn't it? Just for a gift within the family.
It really can be. But, and this is a really important but, the rules are different if you're transferring shares to your spouse or civil partner.
Ah, okay. How so?
Generally, transfers of assets between spouses or civil partners who are living together are done on a no-gain, no-loss basis for CGT.
Meaning no immediate CGT.
Precisely. The spouse receiving the shares effectively inherits your original cost price. So if they sell the shares later, they might have CGT to pay then, based on that original cost, but the initial transfer itself is exempt from CGT.
That's a huge difference compared to gifting to, say, a child.
It is, and this actually leads us nicely onto something called gift holdover relief. It's another way you might be able to manage that immediate CGT hit when gifting to someone other than a spouse.
Gift holdover relief. Okay, sounds useful. How does that work?
Well, essentially, it allows the person making the gift to defer the capital gains tax. The gain you've made isn't taxed immediately. Instead, the gain is held over or rolled over to the person receiving the shares.
So the daughter in my earlier example.
Exactly. She would take on the shares effectively at your original £10,000 cost base for tax purposes. The £40,000 gain is still there, kind of latent, but the tax isn't triggered until she eventually disposes of the shares, perhaps by selling them years later.
So it postpones the tax rather than eliminating it.
Correct. It postpones it. The person receiving the gift pays the CGT eventually, calculated on the gain from the original purchase price. It's a deferral mechanism, very useful if you don't want or can't afford that immediate tax bill.
I can see the appeal. How do you claim this relief? Is it automatic?
No, it's not automatic. You and the recipient need to make a joint claim to HMRC. This is usually done using Form HS-295, which you'd submit alongside your self-assessment tax return.
Yeah, joint claim. Form HS-295. Anything else to watch out for?
Yes, a very important point. Gift holdover relief generally doesn't apply if the shares are considered employment-related securities or ERS.
ERS, what does that mean in this context?
It typically means shares given because of an employment relationship. For example, if you gift shares to your son who also works for your company, HMRC might see it as linked to his employment rather than just a family gift.
Hmm.
We'll come back to ERS, as it can trigger income tax, which is a whole different issue.
Right. Okay. So holdover relief is good for deferring CGT on non-employment related gifts, but we need to flag the ERS issue. Let's park ERS for a moment and move on. What about inheritance tax, or IHT?
Okay, IHT.
Yeah.
When you gift shares, assuming it's not to a spouse, which is usually exempt anyway, it's typically classed as a potentially exempt transfer, a PEAT.
Potentially exempt, meaning it might be exempt from IHT.
Exactly. The potential part depends on whether you, the giver, survive for 7 years after making the gift.
Ah, the famous 7-year rule.
That's the one. If you live for 7 years or more after gifting the shares, their value generally falls completely outside your estate for IHT purposes. No inheritance tax due on that gift.
And if you don't survive the 7 years?
Then unfortunately, the value of the gifted shares might be pulled back into your estate calculation for IHT. The full IHT rate is 40%. However, there's something called taper relief that can reduce the rate if you survive for at least 3 years.
How does the taper work?
If death occurs within 3 years of the gift, it's the full 40%. Between 3 and 4 years, the rate reduces to 32%. Between 4 and 5 years, it's 24%. Between 5 and 6 years, 16%. And between 6 and 7 years, it's 8%. After 7 years, as we said, it drops to 0%.
Okay, so the longer you survive within that 7-year window, the lower the potential IHT rate on the gift becomes. Are there any allowances for IHT gifts?
Yes, there's the annual exemption. You can give away gifts worth up to £3,000 in total each tax year, and these gifts are immediately exempt from IHT. They don't even start the 7-year clock.
£3,000 per year.
Yes, and if you don't use your full £3,000 allowance 1 year, you can carry forward the unused amount for 1 year only. So potentially you could give £6,000 in one go using 2 years' allowances.
Useful for smaller gifts, or maybe chipping away at a larger share transfer value over time. Now, what about family businesses? Is there specific help there for IHT? You mentioned business property relief, BPR.
Yes, BPR can be incredibly powerful for shares in certain types of companies. If the shares qualify, BPR can reduce their value for IHT purposes by either 50% or, in many cases for shares in a trading company you control, by 100%.
100% reduction. So potentially no IHT payable on those business shares at all.
Potentially, yes. But the rules are strict. The company generally has to be a trading company, not mainly dealing in investments like land or securities, and there are minimum holding periods, usually 2 years.
So definitely not automatic.
Absolutely not. You really need specialist advice to confirm if your shares qualify for BPR. It can make a monumental difference to IHT planning, especially for family businesses looking at succession. Sometimes holding on to the shares until death might be better for IHT because of BPR, compared to gifting them and starting the 7-year clock.
That's a really important strategic point. Okay, let's quickly touch on a scenario. Say Sarah owns shares in her successful tech startup, bought for £20,000, now worth £100,000. She gifts them to her son Tom, who also works in the company as an engineer. What are the immediate red flags?
Okay, first, the CGT. Gain is £80,000. Minus 3K exemption is £77,000. If Sarah's a higher rate taxpayer, CGT is 24% of $77K, which is £18,480 payable immediately unless they can use holdover relief. But the bigger red flag here is Tom being an employee.
The ERS issue we mentioned.
Exactly. HMRC might argue this isn't just a family gift, but it's related to his employment. If they succeed with that argument, the £100,000 value could be treated as employment income for Tom.
Meaning income tax and national insurance.
Potentially, yes.
Yeah.
That could be a much larger tax bill than the CGT, depending on his tax rate. It highlights why getting advice before making the transfer is critical, especially if the recipient is an employee.
Okay, let's properly unpack that ERS risk now. You're saying if the shares are deemed employment-related securities, it could trigger income tax for the recipient.
Yes. If HMRC decides the transfer is a reward for employment or arises because of the employment, rather than purely out of family connection, natural love and affection is the phrase sometimes used, then the market value of the shares at the time of transfer can be treated as taxable income for the employee recipient.
And that's taxed at their marginal income tax rate.
Correct. Plus potentially national insurance contributions as well for both the employee and sometimes the employer company. Let's say you give shares worth £50,000 to your daughter who's a marketing manager. If HMRC views this as employment related and she's a higher rate taxpayer paying, say, 42% combined income tax and NACs.
She could face a tax bill of £21,000 on that £50,000 gift.
Precisely. Can be a nasty surprise.
Huh.
So documenting the intention behind the gift, proving it's genuinely a family matter, perhaps part of wider estate planning or family succession, and not linked to their job performance or role is vital.
Can using gift holdover relief help demonstrate it's not employment income?
It can be a helpful indicator because holdover relief isn't available for ERS gifts that are treated as income. So, successfully claiming holdover relief suggests HMRC accept it's a gift for CGT purposes, which might help argue against it being employment income. But it's not foolproof. Proper documentation, board minutes if relevant, and timing are all crucial.
It really sounds like a potential trap for family businesses where relatives are also employees.
It is one of the trickiest areas. Get advice. Always.
Okay. Are there any other smaller taxes we should briefly mention? Stamp duty.
Good point. Stamp duty, or stamp duty reserve tax, SDRT, is usually payable at 0.5% when you buy shares. However, for a straightforward gift of shares where no money or other consideration changes hands, there's typically no stamp duty liability.
So one less thing to worry about for a pure gift.
Usually, yes.
Right. Now let's circle back to something you mentioned earlier, dividends. Once the shares are transferred, say to a child or spouse, they'll start receiving dividends if the company pays them. How are those taxed?
Dividends received are treated as income for the person who now owns the shares. They're taxed through the income tax system, but using specific dividend tax rates.
And what are those rates for 2025, 26?
Okay, first there's a dividend allowance. For 2025-26, the first £500 of dividends are tax-free for everyone.
500 pounds.
Above that, the rate depends on your income tax band. For basic rate taxpayers, it's 8.75%. For higher rate taxpayers, it's 33.75%. And for additional rate taxpayers, it's 39.35%.
Quite a jump between the basic and higher rates there.
It is. And this is where transferring shares, particularly to a spouse or potentially an adult child in a lower tax bracket, can be very tax efficient from an income perspective.
How so? Can you give an example?
Sure. Imagine you're a higher rate taxpayer paying 33.75% on dividends over £500, and your spouse is a basic rate taxpayer paying 8.75%. If you transfer some dividend-paying shares to your spouse, the dividends they receive will be taxed at their lower 8.75% rate instead of your 33.75% rate. Over time, that can lead to significant family income tax savings.
That sounds like a smart strategy. Are there any catches?
Well, HMRC has rules around settlements designed to stop people artificially diverting income purely to save tax. For a transfer to a spouse to be effective for tax purposes, it needs to be an outright gift. Your spouse must truly own the shares and be entitled to the income. It can't just be a paper exercise where you still effectively control everything.
So the gift has to be genuine, with the recipient having full control and entitlement.
Absolutely.
Yeah.
If it's just a sham to avoid tax, HMRC can challenge it and tax the income on you, the original owner. But for genuine transfers between spouses, it's a well-established and legitimate way to potentially reduce the overall family tax bill on dividend income.
Okay, that makes sense. So we've covered CGT, IHT, the ERS risk, stamp duty, dividend tax. It's a lot to juggle. Can we summarize some practical strategies people might use to minimize the tax hit when transferring shares to family?
Definitely. First, for gifts to non-spouse family members where CGT is an issue, strongly consider using gift holdover relief to defer the gain, assuming it's not an ERS situation.
Right. Deferral.
Second, leverage the spouse exemption. Transfers between spouses are generally CGT-free and IHT-free and can help utilize lower dividend tax rates. It's often the most tax-efficient first step. Third, maximize annual exemptions. Use the £3,000 IHT annual gift exemption each year, potentially carrying 1 year forward. And remember, the £3,000 CGT annual exemption may be transfer shares in smaller chunks over time if feasible, although market value changes make that tricky.
Okay, annual allowances. What else?
Fourth, think carefully about business property relief, BPR. If the shares likely qualify, weigh up whether gifting them now, starting the 7-year IHT clock but potentially facing CGT, is better than holding them until death when BPR could wipe out the IHT entirely. This needs careful thought and advice.
A crucial planning point for business owners.
Fifth, consider timing your transfers. If possible, transferring shares when their market value is lower will result in a smaller capital gain and therefore less potential CGT or a smaller value for IHT purposes if the 7-year rule applies. Obviously, predicting market lows is difficult.
Good point, though. Any other key strategies?
Just reiterating the ERS point, be incredibly careful gifting shares to employees or directors, even if they're a family. Document everything meticulously to support the family gift intention.
Okay, that's a helpful list. Let's maybe look at a quick case study to tie some of this together. How about the Patel family, mentioned in the outline? Rajesh wants to gift shares in his successful trading company to his daughter, Anjali, who doesn't work in the business.
Okay, good scenario. Let's say Rajesh bought the shares for £50,000 and they're now worth £250,000. He gifts them all to Anjali.
So, immediate thoughts. CGT.
Yes, a £200,000 gain. That's a potentially large CGT bill for Rajesh. However, because Anjali is not an employee, gift holdover relief should be available if they make a joint election.
Rajesh pays no immediate CGT, and Anjali takes the shares with the £50,000 base cost.
Exactly. The CGT is deferred. Now, IHT, this gift is a potentially exempt transfer, PET.
So, Rajesh needs to survive 7 years for it to be fully IHT free.
Correct. He could also use his £3,000 annual IHT exemption against the £250,000 value, maybe even carry one forward, reducing the value of the PE slightly. But the main IHT point here is BPR.
Because it's a trading company.
Yes. Assuming the shares qualify for 100% business property relief, then even if Rajesh died within the 7 years, the value of those shares gifted to Anjali should still benefit from 100% BPR, meaning no IHT would likely be due on them anyway.
So in this specific case, BPR effectively protects against the IHT risk even within the 7 years.
In many trading company scenarios, yes. That's why understanding BPR eligibility is so important. It can override the usual PE rules for qualifying business assets.
That really illustrates how the reliefs interact. What about more complex situations, like shares going into a trust or to family living overseas?
Ah, yes. Those get even more complicated. Transferring shares into most types of trusts can trigger an immediate lifetime IHT charge, not just a paid. And transferring to family overseas brings in potential double taxation issues, residency rules, and needing to understand the tax system in the other country as well as the UK's.
So specialist advice, absolutely essential there.
Definitely. Trusts and international transfers are really areas where you need experts who deal with that specific complexity.
Which brings us back to the value of getting professional help. Why is involving someone like a tax accountant from ProTax Accountant so crucial here?
Well, as we've seen, it's a maze, isn't it? CGT, IHT, income tax via ERS, various reliefs like holdover and BPR, allowances, timing. An experienced tax accountant can analyze your specific circumstances and goals.
So not just applying generic rules.
No, tailoring the advice. They can identify which release you actually qualify for, calculate the potential tax liabilities under different scenarios, help you structure the transfer tax efficiently, and crucially, handle all the necessary paperwork like the HS-295 form for holdover relief, ensuring everything is compliant with HMRC rules.
Peace of mind, really.
And potentially significant tax savings. Let's look at that Thompson family case study from the outline. David wants to gift shares in his manufacturing company, worth £500,000, original cost £50,000, to his daughter Emily, who was a director in the company.
Okay, alarm bells ringing already with the director role. What are the risks without planning?
Huge risks. First, CGT for David on the £450,000 gain. At 24% after the 3K exemption, that's over £107,000 in immediate tax. Second, the ERS risk. HMRC could argue the £500,000 value is employment income for Emily. At higher rates, that could be an income tax and NIC's hit of potentially over £200,000 for her. Plus, IHT potentially due if David doesn't survive 7 years.
A potential disaster. How did ProTax Accountant help, according to the case study?
Right. First, they worked with David and Emily to clarify the goals, primarily family succession and reducing David's future IHT exposure, not rewarding Emily's directorship.
Documenting intention.
Crucially. Then, for CGT, they advised using gift holdover release. By making the joint claim and documenting the family succession motive, they successfully deferred David's £107,000 CGT bill. Emily took the shares at the £50,000 base cost.
Okay, CGT handled. What about the ERS risk?
This was key. By carefully documenting the transfer as part of a long-term family succession plan, clearly separating it from Emily's remuneration package as a director, and ensured the timing context supported the family gift argument, they successfully mitigated the risk of it being classed as employment income. This potentially saved Emily over £200,000 in income tax and NICs.
That's a massive saving. And IHT.
The transfer was a PET. David used his annual exemption. And because it was a qualifying trading company, ProTax Accountant confirmed 100% BPR should apply, meaning even if David died within 7 years, no IHT should be due on those shares.
Fantastic result. Any dividend planning?
Yes, they considered the dividend flow. Emily was likely in a lower tax bracket than David for dividends, so the transfer shifted future dividend income to be taxed at her potentially lower rate. But they ensured the gift was absolute, giving Emily full control to avoid the settlement's legislation.
And compliance.
Pro-tax accountant handled all the paperwork, the holdover claim, ensuring company records reflected the transfer correctly, advising on disclosures for tax returns.
So the outcome for the Thompsons was significant savings and peace of mind.
Absolutely. They avoided immediate CGT, mitigated a huge potential income tax risk, secured IHT efficiency through BPR, potentially optimized dividend tax, and ensured full compliance, all through getting proactive, expert advice before the transfer.
It really underscores the value. And that advice isn't just a one-off, is it?
No, a good tax advisor provides ongoing support. Circumstances change, tax rules change. Having that relationship means you can revisit the planning as needed.
It seems crystal clear then. Transferring shares to family while done with the best intentions is just fraught with potential tax complexities.
It really is. Getting it wrong can be very costly.
So for anyone listening who is contemplating this, the strong message today, brought to you through the arrangement by Pro Tax Accountant, is to seek professional, personalized advice before you act.
Couldn't agree more.
You need experts who understand all these interacting rules, CGT, IHT, ERS, BPR, the lot. To get that tailored guidance, you really should reach out to a specialist firm like Pro Tax Accountant. They offer a free initial consultation, which is a great starting point.
That's a sensible first step. Just talk through your situation.
You can find them online at https://www.protaxaccountant.co.uk or just give their team a call. Taking that step to get advice up front really is the key to making informed choices, potentially saving a lot of money, and making sure that transfer of assets to your family happens smoothly and tax efficiently.
Well said. Plan ahead. Get advice.